Good morning, everybody. Welcome. For me personally, it's always great to be back here at the New York Fed. This has all been renovated since I left. You guys have done a terrific job sprucing up the place. Today's conference is a great event from my perspective. It's so wonderful to have the opportunity to have the Bretton Woods Committee to be able to collaborate with the New York Fed on the topic of central banking. As you know, the Bretton Woods Committee has evolved a lot over the last few years. We've broadened out our footprint in terms of the issues that we tackle. We're not just doing convenings, we're also doing policy work and moving into central banking, financial stability, digital currencies. Those are all areas that we think are an important focus. Because the reality is, when you think about international policy cooperation and coordination, it's not just the realm of the IMF and the World Bank. It also extends to a whole other set of areas. And we saw that very visibly in March of this year when events in the US probably were the final straw that pushed Credit Suisse over the edge. So today's event, we're going to focus on central banking. The way the day is going to run, John Williams, the 11th president of the Federal Reserve Bank of New York, is going to open with a keynote address. Then we're going to have two panels. The first panel is going to be on policy tools, and unfortunately we've had to have a change in our program. Arminio Fraga made the trip to the United States, got here yesterday, wife tested for COVID, positive, and so Arminio has had to excuse himself, so that's unfortunate, and he will be very much missed. But we still have some really good panelists on our first session. Yi Gang, formerly head of the People's Bank of China, Neal, who's the head of the markets group at the New York Fed, and Rebecca Patterson, who was a chief investment officer at Bridgewater up until very recently. Then we're going to have a panel on monetary policy, financial stability, and the digital frontier. That's going to be moderated by Nia Narula. I'm going to be on that panel along with Nellie Lang, Undersecretary of Treasury, Gordon Liao, and Per Van Zelowitz. After that, we'll have a lunch downstairs in the living room, one of the great venues for lunches anywhere in the world, in my opinion. And Kiku Honda and Emily Slater are going to have a fireside chat talking about multilateral reform. So very full day. Just as a reminder, press is present. Everything that's said is on the record. So just keep that in mind. So we're going to start today with John Williams. John, thank you so much for co-sponsoring this event. Thank you all the New York Fed staff. You guys do such an incredibly great job, hosting things. It was great when I was here. John told me it's exactly the same. This is one of the best places to do things. As I said, John is the 11th president and CEO of the New York Fed. He's also vice chair of the Federal Open Market Committee. But also, people probably don't know this as much, he's also the chair of the Markets Committee in the BIS, the Bank for International Settlements. And that's really germane to our discussion today because we're going to be getting into some of the details of the plumbing of the banking system, about central bank operations, about how markets work, how the central banks interact with financial markets. And that's a really great perch that John sits. Prior to being the president of the New York Fed, he was president of the San Francisco Fed, head of the research department there. And John is also a renowned research economist. It makes me very jealous, frankly. I don't have anything like that on my resume. And probably his most famous work is the work he did with the late Thomas Laubeck on R-Star, which you hear a lot about these days because people are trying to figure out how restrictive is monetary policy anyway? Well, that depends critically on R-Star, and John and Thomas did the path-breaking work on R-Star. So with that, let me turn it over to John. The floor is yours.
Thanks, Bill, and good morning, everyone. Yeah, we did spruce up this room. It's actually quite nice. And I agree with you completely. It's a great venue for this event. both in this room and going to the Liberty Street dining room. So welcome again to the Federal Reserve Bank of New York. We're very pleased to be co-hosting this conference with the Bretton Woods Committee. You've got a great program ahead of you. But my remarks will focus on the economic picture for the United States, including monetary policy actions we've taken and my outlook for the economy. So before I go any further, I have to give the standard Fed disclaimer. The views I express are those of my own and do not necessarily reflect the Federal Open Market Committee or anyone else in the Federal Reserve System. So the Federal Reserve has a dual mandate set by Congress to achieve maximum employment and price stability. We're doing well on the employment side of the mandate. The unemployment rate has been below 4% for the past 21 months. That's the longest stretch since the 1960s. And it's in line with my personal 3.75% estimate of the unemployment rate expected to prevail in the economy in the longer run. But the imbalances between supply and demand that have persisted since the onset of the pandemic have contributed to unacceptably high inflation. As measured by the Personal Consumption Expenditures Price Index, inflation surged to a 40-year high of just over 7% in June of last year. And since then, we've seen the inflation rate fall to 3%. This is a significant and welcome decline. Nonetheless, inflation is still too high. Price stability is a bedrock upon which our economic prosperity stands, and is essential to ensure maximum employment over the long term. The FOMC is committed to returning inflation to its 2% longer run goal on a sustained basis. So to understand why inflation rose so much and why it's now moderating, I've been using the metaphor of an onion for the past year. Each layer represents a different sector of the economy. The outermost layer of our inflation onion represents globally traded commodities. As demand for commodities soared at the onset of the pandemic, inflation surged, then rose again when Russia invaded Ukraine. By late June of last year, food price inflation had increased to over 10%, and energy price inflation had skyrocketed to over 40%. Over the past year, global demand has come into better balance with supply, thanks in part to restrictive monetary policy from many central banks around the world. Commodity price inflation has come down significantly. Food price inflation has dropped to about 2.5%. Even the cost of a Thanksgiving dinner was cheaper than a year ago. And energy prices have been falling over the past year, pulling down the overall inflation rate rather than pushing it higher. The onion's second layer is made up of core goods that exclude food and energy. Here, too, we're seeing the effects of this rebalancing of supply and demand. And global supply chain bottlenecks, which triggered widespread shortages of goods during the pandemic, are mostly a thing of the past. The New York Fed's Global Supply Chain Pressure Index, which measures the extent of supply chain disruptions, attained its most favorable reading on record in October, based on data going back to 1998. As a result of the rebalancing of supply and demand and the easing of the supply chain bottlenecks, core goods inflation is now running about 0.25%, and it appears to be on its way to returning to pre-pandemic rates. While the outer layers of our onion have seen the fastest and largest improvements, the inner layer is making progress too. After peaking at around 5.75% earlier this year, core services inflation is now up around 4.5%. And more recent readings in recent months point to further slowing of inflation in this category. Now, a big driver of the surge in core services inflation has been the sharp increases in the price of shelter. Shelter price inflation was boosted by strong demand and limited supply during much of the pandemic and its aftermath. More recently, rents for newly signed leases have been increasing closer to pre-pandemic rates. And as these data are incorporated into the official statistics, the inflation rate for shelter should continue its downward trend. Inflation for services excluding housing and energy is also beginning to move in the right direction. Over the past 6 months, inflation in this category has slowed to about 4%, well off the 5.25% peak we saw at the end of last year, 2021. And that summarizes what's happening with the various layers of the inflation onion, but what's it mean for inflation going forward? So one indicator that is very important for that is inflation expectations. Longer run inflation expectations are at levels consistent with the FOMC's 2% longer run goal. And according to the New York Fed's monthly survey of consumer expectations, medium-term inflation expectations, which were elevated in 2021 and 2022, are now fully back to pre-pandemic levels. Meanwhile, 1 year ahead inflation expectations have fallen dramatically since peaking at nearly 7% last June. They are now only about 3/4 of a percentage point above average levels seen between 2014 and 2019. Now, a second useful indicator for inflation trends is the New York Fed's multivariate core trend inflation, or MCT. After reaching nearly 5.5% in June of last year, the MCT is now at 2.9% in September, and other indicators of underlying inflation are similarly showing significant declines since last year. So let me turn to the other side of our dual mandate, employment. After the recovery from the pandemic recession, the labor market turned red hot. Demand far exceeded supply, and this imbalance contributed to the rising wage growth and higher inflation we saw. Numerous indicators point to a gradual return to balance. Job openings continue to trend downward. The quits and hire rates are back to around pre-pandemic levels, and so are perceptions of job availability and the ability to fill jobs. Wage growth, although still elevated, has slowed considerably. We've seen meaningful improvements in the supply side of the labor market too. Labor force participation has increased significantly, and immigration rates have returned to pre-pandemic levels. But there are limits to how much supply can increase, and some further reduction in demand is still needed to fully return balance to the labor market. The FOMC has reached a restrictive stance of monetary policy. This is working to bring demand into better balance with supply and inflation back to our 2% longer-run goal. Earlier this month, the FOMC kept the target range for the federal funds rate unchanged at 5.25% to 5.5%. Along with our restrictive policy actions, financial conditions have tightened, driven in part by an increase in longer-term Treasury yields since the summer. While statistical models of Treasury yields generally attribute most of the increase to a rise in the term premium, financial market participants have expressed a wide range of views on this, with little conviction around any single explanation. The rise in yields and the elevated volatility likely reflect heightened uncertainty about the outlook for the economy and of future interest rates. Taking into account the tighter financial and credit conditions, I expect GDP growth to slow next year to about 1.25%, and the unemployment rate to rise to about 4.25%. I expect inflation to continue to move down to our 2% longer-run goal. As I mentioned earlier, slowing shelter price inflation should help bring the inflation rate down. And based on New York Fed research that shows a strong relationship between the global supply chain pressure index and goods price inflation, I expect to see additional disinflationary pressures on this layer of the inflation onion as well. Putting it together, my forecast for PC inflation will be around 3% for 2023 as a whole, then decline to around 2.25% next year before closing in on 2% in 2025. All of that said, the future remains highly uncertain, and our decisions will continue to be data dependent. The risks are two-sided, with the possibility of inflation remaining stubbornly persistent, weighed against the risk of a weaker economy and employment. In balancing these risks, and based on what I know now, my assessment is that we are at or near the peak level of the target range of the federal funds rate. Based on model estimates of the longer-run neutral rate, you knew I was going to come to R-star at some point. I mean, that was probably the longest I've ever talked without mentioning R-star in my life. Based on model estimates of the longer-run neutral interest rate, they incorporate forecasts for the current quarter, the fourth quarter of this year. The stance of monetary policy is quite restrictive. Indeed, based on our model, it's estimated to be the most restrictive it's been in 25 years. I expect it will be appropriate to maintain a restrictive stance for quite some time to fully restore balance and to bring inflation back to our 2% longer-run goal on a sustained basis. I will continue to carefully watch the totality of the data to assess whether the current stance of policy is sufficient to achieve our inflation goal. If price pressures and imbalances persist more than I expect, additional policy firming may be needed. Before I close, a word on our balance sheet. At our last meeting, the FOMC said it would continue to reduce the holdings of Treasury securities and agency debt and agency mortgage-backed securities according to the framework that we announced in 2022. The strategy and the implementation of the reduction of our security holdings is working exactly as designed. We've so far reduced our securities holdings by over $1 trillion with no signs of adverse effects on market functioning. So since I first started to unpeel the inflation onion about a year ago, we've seen meaningful progress on bringing inflation down and restoring balance to the economy. But our work is not nearly done. I'm committed to achieving our 2% longer-run inflation goal, creating a strong foundation for our economic future. Thank you, and I think we hopefully have some time for some questions and answers. So anyone have a question? We'll raise your hand, bring them. Do we have?
Any questions?
Come on, there has to be a question here. Here we go. Jan, wait for the mic, please, if you can.
Thanks very much for these remarks. So you said that it is likely to be quite some time before you're going to start cutting. In quantifying how long, what do you think is going to be the more important part of the mandate? Is it still mainly about inflation, or are the inflation goal and the employment goal becoming closer to equally important in determining at what point you might start to ease off on this restrictive stance?
So when I think about monetary policy, if I can just take one step back on your question, I mean, obviously, both mandate goals are very important. Over the past few years, the issue has clearly been high inflation, not a weak labor market or a significant miss on maximum employment, as I mentioned. But both of those are, obviously we want to achieve the best we can on both those goals. I think that in terms of how I view it, it's looking at, like I said, the totality of the data. And I focus, in my mind about the imbalances between supply and demand in the labor market and the economy, and obviously watching inflation. And really thinking, how do we best achieve the imperative, to my mind, of restoring price stability, bringing inflation back to 2% on a sustained basis, but doing in a way that hopefully maintains a strong, good economy. So to me, it's looking at all the data. There's not one indicator or another, and it's basically one of really trying to get that, like I said, those risks to both sides and getting that balance right.
Sorry.
It works.
Yeah, it's working now. Sorry. Could you please discuss downside risks to the economy, what you are watching, and how you would think about it going forward into next year?
What was the very first part of the question?
Sorry, downside risks to the economy.
Well, I think in thinking about some of the risks, downside risks to the economy, clearly, financial conditions overall have tightened quite a bit this year. Credit conditions have tightened as well. There are lags to the effects of credit and financial conditions on the economy. So that's one area where if those effects end up being larger than expected, that's one potential risk. And there's always the unpredicted or unpredictable risks out there. But to my mind, one of the issues that I'm watching carefully is how has the tightening of financial conditions actually affecting spending in the economy, consumer spending, business spending, and how does that affecting ultimately the labor market and inflation. So I think again on the downside risks is some of it's just with the tightening of financial conditions, probably also the kind of diminishing effects of fiscal stimulus on the economy and past monetary stimulus are happening as well. And then on the flip side, the upside risks are that inflation could be stubbornly high, or that the economy has proven to be resilient so far and may prove to be more resilient and stronger going forward.
Hi. Given the 10-year Treasury has come down some recently, and market pricing has indicated that there could be rate cuts sooner than maybe anticipated. What are the conditions that you think would need to come about for the Federal Reserve to pivot and actually potentially lower rates in the near term?
Well, one thing, your question started with the observation that we've seen a lot of movements in long-term Treasury yields and the yield curve in general. I mean, clearly we're seeing very high sensitivity of yields today, and has been now for some time, to incoming data. And I think this reflects some of the uncertainty about the economic outlook and things like that. So that's definitely a lot of sensitivity to incoming data flow, which I think maybe is understandable given the still uncertain outlook. You know, from my position, I mean, the question in front of the FOMC now is, have we achieved the sufficiently restrictive stance of monetary policy that will bring inflation back to 2%? That's the question that I'm focused on, and we don't have an answer yet to that. And you know, as we collect the data, have we gotten monetary policy to that stance? Well, you know, that we feel confident that that's going to bring inflation down to 2%, and then, of course, you know, maintaining that. As I said in my remarks, I expect that we'll need to maintain that stance for quite some time. I don't really want to speculate on the hypothetical situations under which, you know, we would start the process of normalizing monetary policy. Going back to the earlier question, I think it's not based on one or another thing. It would be really about all the factors together, about confidence in bringing in the inflation's moving back to 2% on a sustained basis, and that the imbalances in the economy are you know, really being brought down to the minimum. So again, I don't really want to speculate on exactly how that, you know, how future decisions well off in the future might be made, because it would depend on a lot of different factors, and importantly, really driven by achieving our dual mandate goals. That's all. Okay, well, thank you very much.
All right, thank you so much. So we're going to get started. Arminio Fraga sends his regrets. It's unfortunate he wasn't able, so we wish his wife a speedy recovery, and we wish Arminio that he doesn't get COVID as well. I'm going to start with the introductions. We're just going to go down the line, starting with Yigong. Yigong, a longtime colleague of mine, worked together when I was here at the New York Fed, and he was at the People's Bank of China. He's currently the president of the board of the China Society for Finance and Banking, but before that, he had a very long and distinguished career at the People's Bank of China, where he was the governor of the People's Bank of China beginning in 2018. He also was the head of the State Administration for Foreign Exchange, which was very important, but both in a global sense. I remember when I was the president of the New York, when I was the head of the markets group at the New York Fed, I had some conversations with SAFE, because they had lots of holdings of U.S. dollar-denominated assets at the time, and they wanted to sort of know what was going on here in 2007 and 2008. He began his economics career in the United States, actually, at Indiana University, where he was a professor, and he got his PhD here in the States as well. So, Yigong, welcome, and thank you so much for joining us today. Next, we have Michelle Neal, who is also has something, you know, I have something in common with, because she's head of the markets group at the New York Fed, which is a position I had when I first joined. So it's a great job, because the markets group is basically the part of the Federal Reserve Bank system that actually executes monetary policy on behalf of the Federal Reserve. There is no other central bank in the world where they have one group in one place doing policy and another group in another place actually executing that policy, except here in the United States. And so Michelle holds a very, very important position. As part of that job, she's also on the Committee on Payments and Market Infrastructures at the Bank for International Settlements. Prior to that, she had more than 20 years of expertise in financial services, including she was the head of the fixed income commodities and currencies at the Royal Bank of Canada. So she's had a tremendous amount of markets experience, which is really great if you're running the markets group at the New York Fed. And lastly, Rebecca Patterson, who's also had a distinguished career in the private sector. I got to know Rebecca when she came here as part of the advisory group to advise us on what's going on in financial markets. Recently, she was the chief investment strategist at Bridgewater Associates. Before that, she was the chief investment officer at Bessemer Trust. She's the chair of the Council for Economic Education. That's a nonprofit that's focused on financial literacy for kids. And I'm on the board with her, and she's doing a great job as chairman there. So that's what we have today, and so I think we should just begin. So I'm gonna ask a few questions, and I may have follow-up depending on what we hear from the group. I'm gonna start with the COVID pandemic. The COVID pandemic, we had central banks cut interest rates to zero. or even slightly negative in some cases. Large-scale quantitative easing. It was a pretty, and it all happened very, very, very quickly. It wasn't like 2007, 2008, where the Fed sort of drifted to very sharp responses. It all happened within a few weeks. So I'm going to start with Yigang. How you evaluate monetary policy over that period, you know, the 2020 when the pandemic was hitting and central banks were reacting in pretty aggressive ways?
No, thank you. I think G30 released their report on monetary policy. In that report, there is one important comment saying that in the past 3 years, that the major central bank has been consistently wrongly predict inflation. I think that's a problem that we have to learn the lesson from it. In terms of China, we have a different story because People's Bank of China, during the pandemic, they by and large predict the inflation in the neighborhood pretty correctly, and also they identify the downward pressure for economic trend. Therefore, during the pandemic, they cut interest rate several times, total something like 0.5%, not like other major central banks cut the interest rate dramatically to zero. They cut it cautiously, and then basically try to use accommodative monetary policy to support economic growth. The major accommodative monetary policy we used in pandemic period, one is supporting small and medium enterprises, and also the self-employed people, and we call it inclusive finance. And during the pandemic, we pretty much have 60 million small and medium enterprises, including the family business, getting supported. That way, we maximize employment, and also we try to help those enterprises roll over their existing loan, and so on and so forth. So we kind of continue to use monetary policy to support the economic growth. And for this 3-year period of pandemic, the M2, which is broad money, and the bank lending growth rate, all around 10% per year. So that's the my look of the monetary policy during the pandemic, and also what they did wrong, and why major central banks consistently wrongly predict the inflation during that period. Thank you.
Michelle?
Yeah, I mean, central banks all around the world, as you mentioned, took efforts to support their economies, maintain the flow of credit, and stabilize the financial systems. The Fed response was very fast and very forceful. Most of the 2020 policy actions required close coordination and approval of the U.S. Treasury Secretary under Section 13.3 of the Federal Reserve Act. But in essence, the particular set of measures that central banks used differed according to local circumstances. Interest rate cuts, domestic liquidity facilities, targeted lending operations were widely used to support credit provision. Large-scale asset purchases were conducted by most large central banks, more than during the GFC, and for the first time by central banks of some emerging market economies. Advancing economies with large non-financial bank sectors also established purchase programs for securities like corporate bonds to support the flow of credit through the broader economy, and central banks of emerging market economies also conducted FX operations to counter excessive volatility in the markets. Both advanced and emerging economies ventured into new territory, and in the U.S., the Fed established the Municipal Liquidity Facility, which focused on providing liquidity to municipalities, and 2 corporate credit facilities to support the primary and secondary corporate bond markets, as well as the Paycheck Protection Program liquidity facility.
So anything that you thought, with the benefit of hindsight, anything that you think should have been done differently, or were there gaps in the toolkit that the Fed had that because one problem in the United States is you need Treasury support to actually implement some of these special liquidity facilities?
I think speaking with my colleagues who were here implementing those measures at the time, I think that the range of toolkits and experience that were garnered in the global financial crisis, that were reintroduced, reapproved, tailored, new facilities introduced, I think we've sort of demonstrated that we can act flexibly, nimbly, and I think we can do that in future circumstances.
I think one thing that's underappreciated is the Fed also had a different monetary policy framework, so you could actually add reserves to the banking system without causing a collapse in interest rates. Totally different monetary policy framework than existed in 2007, 2008. Rebecca, looking at it from the market perspective, how do you evaluate? I mean, at the time, people were very positive about the reaction. People got off the market very quickly. They cut rates very aggressively. They provide a lot of liquidity to the market. Of course, then the fullness of time, there was an inflation consequence. How you evaluate that period?
Yeah, I mean, Yigong mentioned the miss on inflation, and that isn't something you can just pin on central banks. Obviously, most market participants missed the persistence of inflation that came and the degree of inflation that came. And I think everyone now is reviewing their economic assumptions, reviewing their models to try to appreciate what did we misappreciate, what did we underestimate, how do we need to be adjusting, whether it was tremendous fiscal policy and how that flows through to the economy, or the fact that households had delevered for a decade after 2008, 2009, so went into the pandemic with less debt, which eventually allowed them to spend more when they started spending again. That was something we should have known and been able to see, and I feel like no one was discussing that in 2020 or 21, and probably should have been. The consumer resilience that certainly this year has surprised us. I think that, in addition to inflation, is something that merits some more thought. But I would double down on something you, Michelle, and you, Bill, said, that the fact that central banks were able to use tools that had been developed previously, you didn't need the time to build new things, although new things were built, but a lot of the tools were largely in place or fully in place, and you could just hit go. And going big and going fast, in addition to, I mean, between March and April, we had $2.4 trillion of fiscal stimulus, so that didn't hurt. But the two of those things combined, I think, certainly prevented a deeper and longer recession than we would have had otherwise, and allowed the market to bottom out within weeks of the WHO declaring, the World Health Organization declaring a global pandemic. That's extraordinary. And I think that we should appreciate how important it is to have those tools ready in advance. And I think we'll talk about this later, but Silicon Valley Bank also underscores the need to have tools ready and to be able to move very, very quickly. So overall, I think the reaction was very positive. I think the speed and the degree of efforts taken for consumers, for businesses, for markets, everything was covered. I mean, truly everything was covered. I think that was an extraordinary success, thanks in part to the tools that had been built in advance.
And not just tools on liquidity, it's also all the regulatory efforts to make banking system a lot more solid. I mean, this is an enormous shock. It's one of the biggest shocks to the global economy ever.
Yes.
And very few things actually broke, which I think is really quite remarkable.
I was just going to add that we didn't necessarily touch on the regulatory response, and the modification of the SLR in the U.S. Europe followed suit with CRD4, and other economies as well, in terms of reducing reserve requirements to keep the flow of liquidity, with, I think, big impact.
I want to dig a little deeper into the central bank responses in crisis. So obviously, I think what happened in 2020, 21 was very successful in stabilizing the economy and supporting the financial sector. But we still have this little bit of a problem in the sense that we don't really know what interventions are going to occur on an ex ante basis. So when a shock hits, initially you'll have a little bit of sense of panic because you're not really sure what's going to arrive in response to the event. Do you think central banks could be clear about what's on offer if things get worse? Because I think there's always this sort of question of like, well, if X happens, what will the central bank do? Yigong?
Yeah, I think we should anticipate the coming market conditions. That's very important. In terms of central bank, you see, one, you have to really look at the liquidity of the market. And also, sometimes there is an external sudden event. It causes some nonlinear response of the market. You have to be prepared for that. The other thing is probably central bank should have toolkits and saying that I have additional instrument in my toolkit, and we can provide extra help if the market is in need.
There's always a tension there. If you tell people too much, you're sort of encouraging them to take on even more risk because the central bank's behind them to bail you out. But if you don't tell people what you're prepared to do, then that sort of encourages people to run because they're not really sure what's really going to be on offer from the central bank.
I think the Bank of England is a good example from last year on how to balance that. You know, when the proposed fiscal stimulus and proposed, increased borrowing triggered a crisis for UK pensions, the Bank of England had already embarked on monetary tightening, and yet they had to do something, or I think they had to do something to avoid a deeper, more systemic crisis unfolding in UK and perhaps even global assets. And by clearly communicating very explicitly, this is financial stability policy, this is monetary policy, they are distinct. We can do two things at once. That's going to be for a limited time period. I think the detail and the clarity of the communication helped avoid moral hazard, people taking undue risk, but also helped create enough confidence to prevent that crisis from worsening. So I think that was a good example of balancing those risks, and the key to me was the incredibly clear communication that was part of that on the part of the BOE.
I want to ask a question to Michelle and Yigang about central bank coordination. So can you explain what actually happens in Basel? All these central bankers go to Basel, 6 times a year. What happens? What's the value of it? What do you learn from your colleagues in other central banks? How is that useful in terms of helping the global financial system work better? Michelle?
Obviously, first of all, I think it's fair to say that we maintain relationships with other central banks at all levels. So at the working staff level, we have, desk-to-desk communications related to things like swap lines and policy implementation tools. And then, of course, as you mentioned, at the BIS, there's another range of relationship building. John Williams chairs the Markets Committee. Roberto Perli, my colleague, who's the SOMA manager, sits on that committee. We have other committees where I think just the compare and contrasting of tools, policy responses, and the effectiveness of those activities is invaluable and keeps the lines of communication from bilateral dialogue outside of kind of those more collective forums as well.
The best part of my central bank career is going to BIS several times a year. And I feel every time a lot of meetings and a lot of lessons and class, something like taking a class. And I really enjoy that process and learned a lot. One thing is we promote central bank coordination and cooperation during the difficult period. And in the crisis time, you see dollar swap, US dollar swap provide a large facility that calm down the international market, dollar squeeze and shortage, and played a very positive role in it. And also, if we look at the global financial safety net, there are several layers of global financial safety net. On the top, probably should be the IMF and the World Bank. You see, providing the global, say, SDR and the loan, that's at the top. And then the second layer would be the regional layers. In North America, regional layers, and also in Europe. European stability mechanism is a regional layer of safety net. You see, during the previous the Europe sovereign debt problem crisis. And actually, we participate actively in this ESM mechanism and providing, probably as the foreign central bank, providing the largest amount of helping the European from the Greece debt crisis and also the sovereign debt crisis. And also in terms of our area, Asia, we have a Chiang Mai initiative of multilateralization. You see, that's already in being tested and being ready to use. And also among the BRIC countries, we have a BRIC contingency liquidity arrangement. That's also kind of a regional help. That's the second layer. The third layer is a bilateral swap. And the bilateral swap, of course, you see, because US dollar is the main funding currency, the US dollar bilateral swap is very important. And also other local currency swap is also play a positive role. For example, People's Bank of China, we have the local currency swap with about 40 central banks and monetary authorities. The total amount is over 4 trillion renminbi, which is about, say, something more than 600 billion US dollar. And during this local currency swap, it can support the financial stability, and also it can promote the trade and investment activities. During the, you see something like a debt crisis, the local currency swap can play a positive role. For example, in our People's Bank of China local currency swap with Mongolia and with Argentina played a very constructive role and helping MF to put the package together. They need some bridge, or they just shortage a block of liquidity. They played that role and make the MF effort went through smoothly. So that basically, if you global financial safety net, IMF at the top, regional second layer, and bilateral currency swap and the third level, and maybe countries' own FX reserve at the bottom as a defense. I think through this kind of experience and also the Lehman crisis, European sovereign debt crisis, and also the recent pandemic period, we all learned that central bank committee, we should closely coordinate and in cooperation. That will increase the confidence of the global financial market.
Yeah, I think the swaps are hugely important because they make it so that people don't have to forcibly sell dollar assets, which can then add to turmoil in financial markets. And just the fact that the swaps networks exist make people pretty confident they'll be able to get funding no matter what. Now, you know, it's interesting today, we sort of accept foreign exchange swaps as sort of like a normal part of the toolkit. It was actually pretty controversial when we did it back in 2008. I actually had to testify before Congress, explain why swaps were a good thing rather than a bad thing. But it seems like we've now got to the point where this is acceptable as an important toolkit of monetary policy. I'm going to flip ahead now to this year, March 2023. We had some interesting problems in the financial system, both in the United States with Silicon Valley Bank and a few other banks getting into difficulties, and obviously Credit Suisse in Europe. And so the question I have on this is does monetary policy have implications for financial stability? So we had a very, very accommodative monetary policy for a number of years, and then we had followed by a very sharp rise in short-term and long-term interest rates. And so the question is, can you really conduct monetary policy over here and financial stability over here, or is there actually a connection? Is this something that central bankers need to think a little bit more about? I'm going to start with Rebecca on this one.
Sure. Obviously, there's a connection between financial stability and monetary policy, and I think we've seen the go big, go fast, both in the wake of Silicon Valley Bank. Literally within 48 hours, there was steps taken by the Fed, the Treasury, the FDIC to take care of depositors. We had a new term bank facility launched. We had additional liquidity provided for eligible institutions, literally within 2 days, over a weekend, and that went a long way to creating financial stability and confidence again and protecting the downside. And you saw that in price action in bank companies' share prices. So one does affect the other, obviously. What I worry about more are the slower moving evolutionary things. I think central banks have become more and more adept at reacting quickly and well to crises when they emerge. But things that happen more slowly behind the scenes, it's not that they're not seen, but they don't get the same sense of urgency. And the example I would use when I think about the low for long decade, if we will, I'm generalizing, but in that period, investors needed to reach out the credit curve, reach out the liquidity curve, take more risk to get the same return, because bonds didn't get you what it used to. As a result of that, a lot of assets moved into alternatives, particularly illiquid investments, private equity, private credit, real estate, and they moved into asset managers overseeing those things. So the non-bank financial sector, which now represents about half of global financial assets. So it's grown about 10 percentage points in 10, 15 years. So half of the world's assets are overseen by firms that don't have the same regulatory scrutiny, are not required to provide the same transparency. So in this case, monetary policy, which probably was needed to prevent prolonged deflation or low inflation, but it did contribute significantly to rise of risks we think we know are there, but how are we going to be able to see them early enough to prevent a crisis if the risk emerges into a shock? We don't have the visibility. And so those are some of the topics I think as the world evolves, central banks would be would use their time well to make sure they're looking ahead at, as the world evolves, what are the next level of shocks that could arise, and do we have the tools for them? We know we have a certain set of tools that work well for some things, but in a world where we have a crypto ETF and that industry grows significantly, in a world where we have more and more zero-day options that are heavily used by retail investors, could those things create a new source of vulnerability? Do we have the tools for those? So I think looking ahead at the more evolutionary things and trying to anticipate some of the shocks that could occur, those are things I see happening from the low for long that I worry about in the next 5 years.
Yeah, the growth of the non-bank financial sector has been pretty striking over the last, not just the last few years, last few decades. And I think people are quite nervous about it because they don't really know what risks reside in there. China has quite a bit of activity outside the core banking sector. How do you think about it from the Chinese perspective?
We have a lot of discussion of this. You see, if we have the ideal scenario, that is monetary policy responsible for price stability, and the macro-prudential policy responsible for financial stability. But that's the ideal case. And usually, in reality, they intertwine together, and you have to make a tough decision when you consider monetary policy. For example, that if banks hold a lot of treasury bond, and then you continue to hike interest rate, and then, of course, that would cause some stability problem. And as a central banker, when we do the decision making, we have to consider this two aspects together. For People's Bank of China, the official mandate is that we have a twin pillar. One is monetary policy, the other is macro-prudential and financial stability. So that I think we always thinking that price stability is overall priority for us. So that we have that kind of sentence in our People's Bank of China law. But on the other hand, financial stability is always the very important issue that sometimes if you just consider the price stability, the two might conflict of each other. In those kind of difficult situations, you have to make the balanced and a precise choice as how far you can go, and also the time sequence, or you have some preemptive measures to prevent something happening. I think we have a lot of practice for this. And to give a summary, that is for the central banker, they have to consider monetary policy and financial stability at the same time. And usually they make a joint decision, but different central banks might have different mandate given their priority ordering slightly different from central bank to central bank. And that is also very subtle and in terms of policy implications.
Sounds like you need good judgment to balance these two competing objectives. Michelle, any thoughts on this?
Yeah, I mean, obviously, I think they are related, monetary policy and financial stability. The stable financial system, supporting a smooth monetary policy transmission, helping to, in our case, achieve the FOMC's monetary policy goals of maximum employment and price stability. Similarly, the monetary policy implementation requires awareness of vulnerabilities that could lead to abrupt changes in credit conditions and therefore harm to the economy. We have, the Board of Governors has a framework for monitoring financial stability. It publishes the semi-annual financial stability reports. In the markets group, we do a lot of vulnerability analysis, generally speaking, for our stakeholders as well. And really, monetary policy in that regard continues to influence the overall level of market rates, while backstop tools such as the discount window, the standing repo facility, standing swap lines, and the FEMA repo facility, which we really haven't talked a lot about yet, available to really attenuate the impact of financial stress following shocks.
So I think in our discussion, we sort of concluded that the central banks have done a lot of things. They developed a much broader set of tools to address economic and financial stability risks, because we've had some pretty unusual economic events over the last 15 years or so. When you look at the central bank toolkit and authorities, is there anything that's really important that's missing? Obviously, it differs across central banks around the world. The Bank of Japan can buy equities, the U.S. Federal Reserve cannot. Do you think there's anything really important that central banks should have that they don't have right now? Or is it just really more about making the existing institutional setup work better?
I mean, I would reiterate what I just said, that I think it's in central banks and policymakers generally, their interest to not just think about what might we have missed in the past, but what could be coming in the future. And obviously, there's an infinite number of risks. You can't anticipate all risks. But to the degree you see things evolving, how could this go badly? Do some tabletop exercises, think about stress scenarios, and then think about what tools might we need to build. I think that is probably a good use of time, without naming what that tool is right now. I don't know, but thinking about what it might need to be. The other thing, it's not a tool per se as thinking about what central banks are trying to do with financial stability and monetary policy. I think there is sometimes a risk of mandate drift, and to the degree different things are trying to be achieved, the more goals you have, the more tools you need, the harder it is to achieve any single goal, and the clarity becomes so much more important in communicating with the public. And I think about during the last few years, it was a smaller nuanced thing, but some members of the Federal Reserve were discussing the unemployment part of the mandate and almost redefining what it was. Instead of just being a single number, it was, well, we need to get a certain unemployment rate, but across different income cohorts. I thought, well, that's different. Is that formal? Is that a nice to have? And I think if the risk is if those things aren't made very explicit and very clear, it could create some confusion by market participants, which makes it harder for them to know where the puck is going.
Right.
So that would be the only thing I'd stress, that just clarity on how many goals, what are the goals, is this color, interesting, or is this actually part of the mandate now?
Yeah. On my sort of list is really making sure that the lender of last resort works well. You know, at the end of the day, only the central bank in any country has the ability to expand the balance sheet capacity for the country as a whole. And so when people are fleeing from any set of assets, there's only one entity that can actually take on those assets in times of stress. I think we saw in March 2020 that the lender of last resort function, at least in the United States, didn't work perfectly because the speed of the outflows was so great that the Silicon Valley Bank literally couldn't bring the collateral to the Fed in a timely way to get the cash that their depositors were demanding. Michelle, do you think there's something we could do on the discount window lender of last resort function to make it work better here in the United States?
I mean, I think we have to ensure that everyone is prepared and operationally ready to do so. And so, you know, since that time, we've worked very closely with our colleagues in supervision to make sure that depository institutions of all kinds that have access to the discount window are set up, they're documented, they're operationally ready, they actually know what to do and how to come to the window and how the market infrastructure works. And so I think that that's one of the most important things that we can do to ensure that those that can be transmitted as quickly as possible, because most of the issues that occur are timing, they're operationally orientated.
Do you feel like you have the tools, you just need to make sure everyone's well prepared going in?
Yeah, I mean, obviously, as Rebecca referred to, you know, we obviously came to the market with the BTFP. That gave people the ability to, you know, really achieve full par value with their securities at a time where they otherwise might have to be selling them at a loss. You know, similarly at the discount window, we did something similar for loans. You know, obviously, we've now gone through our annual process of recalibrating our margins and collateral, so that's sort of fallen away now. But, you know, I think both of those things in tandem sort of supported enhanced, you know, lending considerations in challenging and stressed market circumstances.
People's Bank of China, you have all the tools you need?
Yes, you see, on our list, first we have tool of price stability. And then, like yours, you see, you have to maximize employment, which means that you have to support economic growth. And then financial stability tools, that's certainly very important. I raise, beyond these three, I raise the fourth one, which is a little bit controversial, is climate change risk, which is green and sustainable finance. In the past 5 years, People's Bank of China, given the climate change risk, they experiment some monetary policy tool of dealing with green and sustainable finance. We create two facilities that help carbon emission reduction. The focus of those relending facility is that to encourage commercial banks who use those facilities to disclose their carbon print, so that all the commercial bank use the instrument. They have to, on a quarterly basis, they have to declare what kind of activity they support and what's the amount of carbon reduction for the carbon emission. And we already have 6 quarterly reports, so that two instrument already implement for more than 18 months, so that we have 6 quarterly report. And you can see that that is very helpful, because first of all, it increases the total public awareness of the urgency of climate change. And if you have that information disclosure, and make a lot of people start to comment on it. And second, you see the climate change, the most difficult part is information disclosure. Whether you see how to measure it, it's a very difficult issue. And we have this facility, then they can continue to produce this quarterly report, which means at the beginning, they might a little bit rough, and then gradually over the time series they release, They learning by doing, and also thanks for a lot of our European colleague, American colleague to share their experience, so that our information disclosure quality getting better. In the past 18 months, you see that's already indicated because these two facilities, we have decreased carbon emission by more than 150 million ton in the past 18 months. So that is a good start for the country and also for the world. I think my point is that in terms of central bank cooperation, a global central bank forum, we have to, add this climate change risk into our discussion beyond the price stability, maximize employment, and financial stability.
And do it in a way that's consistent and
Yeah.
comparable across different countries and regions.
Yeah, I know there is a difficulty of a mandate issue. Different central banks have different mandate, but it doesn't matter. Even you don't have the mandate, then the central bank community should consider this kind of tool or instrument into our monetary policy toolkits. And in this regard, China and the U.S., we co-chaired the G20 Sustainable Working Group, so that People's Bank of China and the U.S. Treasury, we produced the roadmap for the G20. And also another achievement is People's Bank of China and the European Commission, we jointly agreed on a common ground taxonomy between Europe and China. We know there are a lot of differences, right? And then we have a first edition and a second edition. On the second edition, we already have 80% overlap between China and Europe. It covers 72 facilities that helping reduce the carbon emission in our common ground taxonomy. That will help the green capital or green bond across border movement, Europe and Asia.
Yeah, because this clearly has to be funded on a global basis.
Yeah, because we have a common taxonomy, common ground, a common measure criteria. So that in this kind of climate change field, I feel this is just the beginning. We have a large potential to achieve.
Yeah, I agree with you. I agree with you. Yeah, the work will be going on long after we're gone, I think. I want to turn to switch gears and talk about central bank digital currencies. Lots of pilot programs around the world. China has a very big pilot program. A few small countries have actually implemented central bank digital currencies. I'm just going to start with a very open-ended question. Like, where are we headed? Is this actually going to happen? And if it does happen, what are the likely consequences from central bank digital currencies? And how do we maximize the benefits so this can be useful on cross-border applications? Like, international payments are woefully inefficient today, and one could imagine a regime of central bank digital currencies that actually made this much more efficient. So I'm just going to start with Rebecca. Where are we headed? How should we think about this?
Sure. So I started my financial career covering currency markets. So cryptocurrencies intrigued me from the first day, and it's something I've been trying to follow, both the private cryptocurrencies and the CBDC. I mean, we're going down the road. As you said, there are a few countries already that have them implemented. They're using them on a daily basis. Half the world's countries are now experimenting or studying a cryptocurrency, or a CBDC, excuse me. And we know the world is going increasingly towards cashless, right? We're going to a digital payment world. And there was a good Pew Research study that came out late last year that showed the average American household, 41% of them would have a week of cashless, right? So more and more households are being cashless more frequently. And that's up from about 24% in 2015. So it's changing fairly rapidly. And other countries are even further along like that, places like Sweden and Finland. So we're going there, and then the question is, how do you create the interoperability to have CBDCs work not just domestically but globally? Because I do agree with you. I think there's a lot of the potential benefit from reducing remittance costs, reducing payment costs, speeding up payment costs across borders. I think that's probably where the real impact could be, as well as domestically increasing financial inclusion. So I think there's a lot of benefits. In terms of speed, Lord knows, right? I think that some countries have more impetus to move quickly than others. I think the United States is moving particularly slowly, and I think next year I wouldn't be surprised if it gets really quiet, because for better or worse, this is becoming a bit of a political issue in the United States. You do see some members of Congress, you see some political candidates talking about loss of privacy, greater government control with a CBDC or a digital dollar in the US. And so I think one role the Fed and other public sector institutions can play is communicating what it is and what it isn't. And I know that's already happening. President Williams, other members of the Fed have been out there trying to get this message across, but I think that has to just be continued, because if this becomes politicized, it's going to be much harder to push it forward if it's something that the US needs and or would benefit from. But I think we're going down the road. I wonder how quickly it'll happen, when it'll become more broadly adopted by a greater swath of countries, and whether it'll be mainly domestic initially, how quickly it can become cross-border. There's a lot to do. I'm excited by the work the BIS is doing. I think they're really leading the charge and having great collaboration. I think the IMF is playing an increasingly important role, and they now have a guidebook, like your guide to a CBDC. Which is going to be a living, breathing document. I think that's helpful. I think the G20 working group on digital payments is another forum to bring collaboration together, which is required if this is really going to be our future of having digital payments through a central bank digital currency. I think we're going there. I would bet on it if I had to make a bet.
Yeah, I think it's inevitable, because a central bank digital currency has got better attributes than cash, and we're probably not going to get rid of cash. So if you have something that's better than cash, you're probably going to introduce it. Yeah. Just a PR comment here. We just published a brief on central bank digital currencies, the Bretton Woods Committee. You can read our take on it. You know, we think it's basically, it depends a lot on the initial conditions of the country and what the country's goals are, what they actually want to achieve. So it's not going to be the same for every country. But what's particularly important that's still lacking is to make sure that when each country develops their CBDC, that they can actually interact with each other, as Rebecca said. Now, China's gone pretty far down the road here. You have a pretty big pilot program in place. I think there's hundreds of millions of accounts that have been set up. Yes. Yet the actual take-up, the usage of the CNY hasn't really been that great. So tell me, what's happening in China? Where do you think that's headed?
Yes, you are right that right now, after several years of a pilot program, we already have more than 120 wallets created. And also the balance of money in those wallets is something like 0.2% of the total cash in circulation, 0.2% of cash in circulation in terms of central bank CBDC. Yes, I think we call it eCNY is our central bank CBDC. It's the digital version of currency issued by the People's Bank of China. And you know that eCNY is really closely related to the payment system. Although you see it's a matter of cash distribution, equivalent to cash distribution, but it's more linked to the payment system. And our design is we have a two-tier system, which is the central bank, People's Bank of China. We issue the CBDC eCNY to the qualified institution like a big commercial bank and the big tech company like Alibaba and Tencent, and also some telecom companies. So they, as the institution, deal with their customer.
They own the customer relationship.
Yeah, they have their customer, so that we have the first layer is this commercial bank and the big companies. And then they issue the eCNY to their clients. So that in this two-tier design, that is trying to prevent the financial disintermediation. We don't want to change the current distribution channel. We don't want to change the current monetary policy transmission mechanism, so that we don't want to take the market share competing with the market, so that still right now the important market players still provide their customer with their own product. In terms of the technology path, we completely open because different companies, different commercial banks, they have a different approach to their customer. We only set the standard and also the interaction between the different APPs, so that it has to be commonly usable for the whole economy. But as far as how you serve your customer, it's up to you. Yeah, completely up to the financial institution and the big tech company themselves. And also our design, because it's domestic retail is our priority. So that you know that in the central bank CBDC, several central banks already set up their guidance going to the direction of wholesale. The definition of wholesale and retail means that wholesale is just central bank and financial institution transactions. And if you have one party is either household or enterprise or agencies that belong to the retail. And you can see that if you go to the retail direction, which is much more complicated than the wholesale. Yep. And for the wholesale transactions, I think the blockchain approach is working. Mm-hmm. It can be blockchain architecture. Yep. And for our retail approach, you see, if you want to handle that every 1 second, you can handle tens of thousands of transactions.
Throughput problem.
Yeah, that kind of demand and the peak clearance demand make the blockchain approach very difficult, so that we have the centralized approach. But in our centralized approach, that does not rule out the blockchain at the second tier. Mm-hmm. Our second tier, you see the big commercial banks and Alibaba and Tencent, they all have their own blockchain for the sub-applications using the blockchain approach. And also, the centralized approach does not imply that People's Bank of China will have all the information, because I think the big chunk, majority of the information stored in the second layer. In the second layer, client's information is basically, our information is minimal and necessary, right, and totally protect the privacy of the clients. So that's the what's going on in China. I think we have a lot of interesting questions in front of us. Usually, when you have this central bank CBDC, young people like it, and also the local government like it, because it can be very targeted for the local government on a certain, say, elderly group or poverty group, relief programs and so on. It's very efficient.
You make physical policy.
Make the physical policy very efficient, but at the same time, it also create a lot of challenges.
So we'll have you back in 10 years and we'll see where we are. Michelle, any final thoughts on CBDCs? I mean, the U.S. is doing a lot of work on it, but they're not really moving forward with it.
Obviously, we don't have any kind of a decision around CBDC issuance or adoption, but I think at all levels in the system, at the Federal Reserve level, here at the New York Innovation Center, and my colleague Per von Zalowitz is going to talk about this a little bit more in another panel. We're undertaking research around wholesale CBDCs, around the market infrastructure related to the transport of CBDCs, so really those payment layers, the interoperability of those payment layers. Our New York Innovation Center actually acts as a syndicate of the BIS Innovation Hub scheme, and so we work in collaboration with other central banks on those interoperability themes. And I think, going to your point of earlier, some of the consequences, the goals are going to be different by different jurisdictions, and so I don't think we can necessarily sort of solve for that at any kind of global level, but really make sure that the interoperability, so that actually cross-border payments can be made effectively, is a kind of a key area of focus. And then, finally, what I would say is that, the CPMI is also doing a lot of work in its kind of core area of clearing settlement payments and infrastructure, and kind of, so they're really in the sweet spot of sort of helping to kind of monitor the developments and advise, their constituent central banks around some of the growing considerations.
Thank you. We've been talking among ourselves quite a bit. I think it's time to open it up to the audience for questions. I see we have a question over here.
Thank you. This is about the CBDC and central bank policy instruments. If our star continues to be around 0.5%, where I think the Fed of New York still estimates it to be, sooner or later we're going to find ourselves back at the ELB, the effective lower bound on the policy rate. Well, an obvious solution to that problem is, rather than engaging in a bout of QE and another central bank balance sheet expansion, eliminate the ELB by getting rid of cash and introducing a CBDC that pays interest and can pay it, if necessary, at a negative rate. I was therefore surprised in a recent paper by the Bretton Woods Committee and the BIS to see it advocating basically a CBDC, but one that is non-interest paying. That seems to be a wasted opportunity to get rid of the effective lower bound. Thank you.
So Ken Rogoff wrote a book about this very subject, about how you could have a central bank digital currency that would allow deeply negative interest rates. So basically, I'll give you some fiscal transfer stimulus money, and if you don't spend it, it goes down in value. So you have then strong incentives to spend that money in a timely way, and so you can actually, force people to spend the fiscal stimulus as opposed to save it. And so it's clever in that sense. I think the problem, though, for central bank digital currencies using it in that way is you're now muddying the lines between what is the central bank digital currency for? Is it an instrument of monetary policy, or is it something to encourage more efficient payments? So what do you folks think? Do you think it's a good idea to allow central bank digital currencies with deeply negative interest rates?
I mean, my perception, and Yigong is in a much better position to address this, is that China has used some very targeted, smaller scale experiments with CBDCs for efficient fiscal policy, spend it or lose it. To me, it seems like a day two. Right? We need to figure out the infrastructure, we need to figure out the ecosystem, we need to figure out the rules of the road, get it launched on a broader basis, and then if it's up and running, everything's working well, then how else might we want to use it? It feels like trying to do too much too soon would increase the risk that it goes badly wrong, which would be a huge cost.
Or people don't want to even explore it because they're worried about this outcome that they don't like, and so therefore don't want to invest in CBDCs in the first place. Yigong?
Some people love this negative interest rate capability very much, and I wrote an article before that I said that China is still far away from the negative interest rate scenario, so that we are not in urgency to use that. But I think, like Bill said, that in our local government, the pro-consumption campaign, they have a consumption coupon. The consumption coupon could be use it 1 month. You only have 30 days to spend it, and after that it's gone. So that in this case, this is some kind of, put that consideration already into account. But I think that if you really look at the literature on the need for negative interest rate, I think accept that there are tremendous potentials in this design. But my judgment of CBDC is majorly connected to the payment system. Mm-hmm. If you want to use the CBDC as an instrument of monetary policy, that is still need a lot of economic research before you make a conclusion. But right now, I think the better strategy for CBDC research is focusing on the payment system.
I think you and Rebecca very much are
Yes.
in agreement. Michelle, any thoughts on this?
I agree with that.
Other questions? Mark.
Thank you. I had a question for Yigong. So you said that China took a more cautious approach towards monetary policy at the outset, and you emphasize less about shifting rates and more in terms of what you called inclusive monetary policy. Obviously, the US and the East European and Chinese economies are very different structures. Role of state is different. The degree of financial market evolution is different. So my question was about the future of Chinese monetary policies, for example, over the next decade. Do you see China moving more towards using interest rates and less a focus on the, shall we say, credit allocation? And do you see the financial market system? I know you and Governor Zhou tried to liberalize the markets, but do you see that process continuing and that the Chinese market will become much more externally open over the next decade?
Oh, thank you, Mark. The short answer is yes, definitely. I think we, throughout the past 2 decades, we have experience of the quantity approach versus price approach. Price approach is mainly focused on interest rate as a way of allocation and also promote bank lending, allocate resources. If you have the quantity approach, it's more like what we did before, that you have to allocate to each province, to each industry, the amount of credit available, so on and so forth. Compare the 2 approaches, certainly we realize that using the market mechanism as allocation resources is much more efficient than otherwise. So that if you use the market approach, then the interest rate as the price of money getting much more important. Whether you see in the inclusive finance or you are in the say macroeconomic thinking, monetary policy thinking to control the aggregate demand and so on and so forth, interest rate, they always play the most important role. I think from now on, if you look at the next decade, it would be going that direction. And I'm glad that right now we have pretty much already have the mechanism of what is the central bank policy interest rate, and what is the transmission mechanism through the market, and what is the impact on the yield curve. On the short end, basically central bank have the say for the overnight rate and the 7-day repo rate. On the long end, for example, 10-year government treasury is determined by the market. That kind of yield curve and also interest rate transmission mechanism, it's getting more mature in the past decade.
I think we have time for one more. Way up in the back there. That's you, yep.
Hi, thank you for the opportunity to make a question. I would like to ask for the whole panel about why climate risk, how relevant it is for central banking policy and financial stability, and what are the initiatives between U.S. and China in this regard?
I can kick off. There's a lot of uncertainty around how this is going to play out, both from technology that could affect mitigation, adaptation, policies, whether they get executed well in a timely way, if they meet goals or don't meet goals. So there's a huge cone of outcomes. So there's a level of uncertainty around it, of course. But directionally, I think more and more people agree that there is going to be some major economic costs that come from this, and that could create financial stability costs as well. So I think it's, from my perspective, it does fall within a central bank's mandate to be considering these issues as they think about their economic outlooks and financial stability risks. And then I think, as was discussed earlier on the panel, how each central bank pulls it into their mandate indirectly or explicitly is going to vary. And having it as an explicit part of a mandate, you have an additional goal, which means you need additional tools, and that can become more complicated to execute everything well. That's my own view, but I do acknowledge that different central banks are taking different approaches, and I'm thrilled that there are groups like the G30 and BIS where they can come together, collaborate, and try to figure out what is a best practice. Is there one approach or another that's working better than others? And so I would expect over the coming years, we'll probably see some evolution in how central banks approach climate based on what's working and what's not. I think we're still early days in central banks using this as a more explicit part of their economic forecasting and their financial stability forecasting. That would be my perspective, but I'd be curious what others think.
Go ahead.
Yeah. I agree.
Oh, well, that was easy.
I think in the United States, it's tough for the Federal Reserve because the climate change agenda is just politically more fraught here than it is in a lot of other countries. But clearly, from a financial stability perspective, climate is relevant because you can have stranded assets, and you can have companies that are producing products that are not viewed favorably in a world where the climate is really, really important, and those companies then may not be able to obtain funding. So you can have the risk of everything being fine, and then all of a sudden a hard stop, very sudden stop. And I think the central banks, even if the country is not, head over heels, endorsing climate change, the central bank still needs to worry about those financial stability risks. So I think from a supervision and financial stability perspective, every central bank has to have their eye on this because we don't really know how fast the consequences are going to, the negative consequences are actually going to occur, but we also don't know how the market is going to discount that possibility of negative consequences forward. It could be that the market event happens far ahead of the actual climate bad outcome. And I think that makes it very difficult for central banks to think about this. I think we do have time for one more. We can make it quick. Right over there.
No, I think Rebecca touched to the non-banking sector having an impact. I want to take that that part of the discussion into the discussion around CBDC. How do you think central banks should be thinking about all those alternative currencies that already exist on the market and their impact on CBDCs?
I can start
go ahead,
by
Michelle.
saying that, it's really kind of a watching brief, right? We're following different stable coins, we're following different instruments, looking at the proliferation and considering, both the financial stability and, what the longer term, monetary policy implications might be. And so, yeah, and that is actually, that sort of bleeds into some of the international forums that we've been talking about that, are actually taking a very active interest in sort of monitoring various elements of those.
I'd just briefly add, we don't know what will happen, but there's certainly an increasing amount of speculation that a cryptocurrency exchange-traded instrument will be passed sometime next year. And if that were to occur, it becomes, I think, a more acceptable vehicle for more institutional investors. Right now, private cryptocurrencies are still largely traded by retail investors. And if you had larger pools of capital, more diversified pools of capital going into cryptocurrencies, because they have different goals and timeframes, it could reduce the volatility of cryptocurrencies, and that could create a positive self-reinforcing cycle that makes this industry grow. If that happens and it becomes bigger and it's more connected into the traditional financial system, then you have to be more cognizant of what are the risks of that interconnectivity. Right now, there isn't that much interconnectivity, which means that even if something blows up, I shouldn't use that term, but if there is a shock within the cryptocurrency ecosystem, it's staying fairly contained. But with the advent of an ETF, I think it creates the potential for that to change. And we'll just have to watch and see, A, if an ETF gets passed, and then B, what is the institutional take-up afterwards, and how does that affect the volatility and the liquidity of this market? So I think next year could potentially be really important for watching this space. And obviously how that space changes and grows is going to affect the discussions on CBDCs.
Yeah, I mean, I personally think that the regulators need to have guardrails to make sure that cryptocurrencies, stable coins are safe assets, that consumer protection, dispute resolution, all the things that we've seen that have been lacking. As long as those guardrails are in place, then I think the regulators should be, central banks should be pretty agnostic about who's going to actually win the race, whether it be a CBDC or a stable coin or some other kind of instrument. But right now, we don't have a safe regime in the cryptocurrency space, and we need to get that first before we can actually run a fair race. Is my personal opinion.
Yeah, we have to really look at the risk, and you see, we already have several incidents that it could fail easily. So that in this regard, that legal regulation is very important, and also investor awareness. Investor education is very important.
Well, thank you very much. We're going to take a very short break, and then we're going to go to our next panel. Thank you.